All right, let's talk crypto. If you've ever felt like you're on the outside looking in, totally confused, don't worry. You are in exactly the right place. Over the next few minutes, we're going to turn that confusion into confidence by breaking down the absolute must-knows for getting started. Let's just dive right in.
And this is exactly why this stuff matters. The world of money, it's changing faster than we've seen in centuries. This isn't just about some new stock or a flashy tech trend. We're talking about a fundamental rethinking of how value itself works. But, to really get where we're going, we first have to understand why we're moving at all.
So what problem is crypto actually trying to solve? It wasn't just created out of thin air. No, it was a direct response to some of the really big flaws in the system we all use every single day.
And this really lays it all out, doesn't it? On the left, that's the world we know. Banks acting as middlemen, charging fees, causing delays. And let's be honest, not everyone gets a seat at the table. But on the right, that's crypto's promise, a direct system that never closes its doors, open to anyone with an internet connection. It's a huge shift from trusting institutions to trusting code. So how is any of this even possible? Well, the magic behind it all is a technology called blockchain. And please, don't let that word scare you off. The concept is actually surprisingly simple once you get it. Okay, imagine a local shopkeeper's notebook. It's one book in one single place. If it gets lost or someone alters an entry, that record is compromised. A blockchain is like giving a perfect, self-updating copy of that notebook to thousands of people all at once. So to cheat the system, you'd have to find and change all of those copies at the exact same time, which is practically impossible. This incredible security comes from one core idea: decentralization. This right here is the single most revolutionary part of all of this. By spreading that ledger out across a huge network, we completely remove the need for a central authority. No bank, no payment processor, to give the thumbs up on transactions. The network itself becomes the source of trust.
And here's what that actually looks like in practice. In the old world, for Alice to pay Bob, her money has to go through the bank. The bank is the bottleneck, the gatekeeper. But in a decentralized network, Alice sends directly to Bob, and the entire network of users verifies it. It's a true peer-to-peer system for your money.
The very first successful use of this amazing technology was, of course, Bitcoin. It was released way back in 2009 by the mysterious and anonymous Satoshi Nakamoto, and it introduced the whole world to the idea of a purely digital, decentralized asset. And over time, it's earned a very specific nickname:
Digital gold. But why? Well, because just like physical gold, it's an incredible store of value. It's scarce. There'll only ever be 21 million Bitcoin, period. It's durable, living on a global network that can't just be turned off. And it's the most recognized and trusted asset in the entire space. This is why a lot of people see Bitcoin less as a coffee buying currency and more as a foundational savings technology for the future.
Now, beyond Bitcoin, there is a whole universe of other digital assets out there. They pretty much fall into two main categories, and understanding this simple difference is really key.
Coins versus tokens. Here's the easiest way to think about it. A coin, like Bitcoin or Ethereum, is like the native currency of its own country, its own blockchain. A token, on the other hand, is more like a coupon or a loyalty point, or even a company share that's issued inside that country using its existing roads and infrastructure. In fact, most of the tokens you hear about today are actually built on top of the Ethereum blockchain.
Okay, I need you to lean in for this next part, because if you take away only one thing from this whole explainer, make it this. In the world of crypto, you are your own bank. Now, that sounds great, right? All that freedom. But it comes with a massive dose of responsibility. This next section is, without a doubt, the most important one we're going to cover.
I want you to burn this phrase into your memory. Not your keys, not your coins. In crypto, your ownership is proven by a secret piece of data called a private key. Think of it as the one and only master key to your digital vault. If an exchange or a company holds that key for you, they actually control your funds. If you hold it, and only you, then you are in control.
And yeah, being your own bank means there is no customer service line to call if you mess up. There is no forgot password button for your private keys. Transactions are final. They are irreversible. This is exactly why understanding how to secure your own assets is completely non-negotiable. So how do you hold your own keys? With something called a wallet. A hot wallet is just software on your phone or computer, so it's always connected to the internet. It's super convenient for small amounts or for trading.
A cold wallet, however, is a physical device, kind of like a specialized USB stick, that keeps your keys completely offline, away from hackers. This is the gold standard, the digital Fort Knox for securing any significant amount of crypto you plan to hold for the long term.
And when you move your funds to that cold wallet, please follow these steps religiously, especially number 2. I'm serious. Always send a tiny test transaction first. Waiting for that small amount to arrive safely is the best and cheapest insurance you could ever buy against a simple typo that could send your life savings into a black hole, forever.
All right, with security covered, let's finally talk about how to get started with investing. Look, the crypto market is famously volatile, we all know that, but there are some simple, low-stress strategies that are perfect for beginners. Here are 2 of the most powerful ones. First, HODL, which actually started as a funny typo for hold. It just means buying a strong asset like Bitcoin and holding on for the long term, tuning out all the day-to-day noise. And second, dollar cost averaging, or DCA. This is all about removing emotion. You just invest a fixed amount, say $50, every single week, no matter what the price is doing. It smooths out your average cost over time and keeps you disciplined.
And how should you actually structure that portfolio? Well, a really simple framework is to build it in layers. Your foundation, maybe about 60%, could be the blue chips, like Bitcoin and Ethereum. Then your growth layer, say 30%, might be other established projects you believe in. And finally, you can reserve a small, 10% slice for a bit of speculation on newer, higher-risk assets. This gives you a really nice balance.
But above all else, this is the golden rule. Because of how volatile this market can be, you must never, ever invest money that you need for rent, for bills, or for emergencies. This one rule will protect your financial health and let you invest with a clear head, not out of fear or desperation. So there you have it. We've gone from the why of crypto, all the way to the how of getting started safely. We've demystified the tech, we've defined the assets, and we've laid out a playbook for both security and investment. The foundation is now set. The only question left is, what are you going to build on it?